Happy Monday, everybody. Today is June 1st, 2026, and this is your Monday market update. Now, as a reminder, markets were closed last Monday in observance of Memorial Day as we pause to honor and remember the men and women who made the ultimate sacrifice in service to our country. Now we begin June with a full 5-day trading week ahead. Last week was another strong one for investors. The major indices climbed to fresh record highs as enthusiasm surrounding artificial intelligence remained firmly intact. Optimism grew regarding a potential U.S.-Iran ceasefire agreement. Oil prices declined sharply, Treasury yields moved lower, and inflation data came in slightly better than expected. The result was the 9th consecutive weekly gain for the S&P 500 and another month of impressive gains for stocks. Now, before we get into the recap, I want to highlight two planning topics. One planning topic item worth considering right now is portfolio risk audit. Now, over the past several weeks, markets have experienced significant moves in both directions. When that happens, portfolio allocations can drift away from their original targets. The portfolio that was appropriately balanced 6 or 12 months ago may now carry more risk or less risk than intended. This is a good time to revisit your investment strategy and ask a few important questions. Has your time horizon changed? Has your need for income changed? Are you still comfortable with the level of volatility your portfolio could experience during the next market downturn? A risk audit is not about reacting to recent market headlines. It's about making sure your portfolio still aligns with your goals, your timeline, and your comfort level with risk. Sometimes the result is no change at all. Other times, a few thoughtful adjustments can help bring your investment strategy back in line with your long-term plan. As markets continue to move and investor sentiment shifts, periodic risk reviews can be one of the most valuable planning exercises you undertake. Now, another timely planning topic is the recently released Trump account program. Last week, I recorded a brief 10-minute video explaining how the account works, who may be eligible, and some of the planning consideration families should understand. As with any new savings vehicle or government-sponsored program, it is important to separate the headlines from the details and determine whether it fits into your broader financial strategy. If you have questions after watching the video, please reach out. We'll be happy to discuss how it may apply to your family situation. Now let's recap last week's market and let's preview the week ahead. Because Monday was a Memorial Day holiday, the trading week began on Tuesday. Of course, Tuesday, investors returned from the long weekend in an optimistic mood. Markets largely ignored reports of an additional U.S. military strikes against Iranian targets and instead focused on growing confidence that a ceasefire agreement could be reached. Better than expected consumer confidence data, lower oil prices, and falling Treasury yields supported risk assets. Technology stocks led the advance as Micron surged more than 19%, helping to reignite enthusiasm for memory chip companies and the next phase of the AI build-out. The Dow was down 0.25%, S&P up 0.5%, and the Nasdaq up 1.25%. On Wednesday, markets spent much of the day reacting to a steady stream of headlines regarding negotiations between the United States and Iran. Investors were encouraged by reports suggesting progress towards a ceasefire, only to see sentiment cool after conflicting statements emerged from both Washington and Tehran. Falling oil prices continue to help the broader market while technology shares stabilized after the recent rally. By the close, the major averages managed to hold near record levels, the Dow up 0.25%, S&P essentially flat, and the Nasdaq essentially flat on the day. Thursday may have been the most impressive day of the week. Stocks opened lower after overnight reports of renewed military activity between the United States and Iran. Yet investors quickly shifted their focus back to economic fundamentals. Inflation data came in largely as expected. GDP growth was revised lower, and jobless claims edged higher, reducing concerns that the Federal Reserve would need to become more aggressive. Strong earnings and guidance from Snowflake helped to reignite enthusiasm across software and AI-related stocks, while reports of a potential 60-day ceasefire framework between the United States and Iran added to the positive tone. The Dow was essentially flat, S&P up 0.5%, and the Nasdaq up 1%. Friday capped off the week with another push higher. Investors continued to embrace the AI theme after Dell delivered blowout earnings and significantly stronger guidance, driven by demand for AI servers. Falling oil prices and growing confidence that a ceasefire agreement may ultimately be reached helped to keep pressure off Treasury yields and support valuations. By the closing bell, all three major indices finished at fresh record highs. The Dow up 0.75%, S&P up 0.25%, the Nasdaq up 0.25%. For the week, the Dow gained about 0.75%, S&P gained roughly 1.5%, and the Nasdaq led the way with a gain of just over 2%. The S&P 500 has now posted 9 consecutive weekly gains and continues to benefit from AI-driven earnings growth, easing geopolitical concerns, lower oil prices, and moderating treasury yields. But let's look under the sheets a little bit, because technology carried this market through May. Technology stocks gained nearly 15% for the month, far outpacing every other sector. Consumer discretionary was up roughly 4%. Healthcare rose about 4.5%. Communication services up about 3%. Industrials, real estate, consumer staples, they posted only modest gains, while financials, energy and utilities and materials, they either lagged or they declined. That does tell us something important. The headline indices reached record highs, but much of the advance was driven by a relatively small group of large cap technology and AI related companies. Snowflake's 37% surge following earnings helped reignite the AI trade after a brief cooling off period early in the week. Even on some of the market's strongest days, fewer than half the S&P 500 companies participated in the rally. Breadth remains relatively narrow, while the major averages continue to push to new highs. That doesn't necessarily mean the rally is unhealthy, but it does mean investors should pay attention to concentration risk. When leadership becomes heavily dependent on a small group of companies, those companies carry an outsized influence on the direction of major indices. Bond market also offered an important message last week. Treasury yields fell across the curve, with the two-year Treasury ending nearly 4%, the 10-year Treasury near 4.4%, and the 30-year Treasury below 5%, which is notable. What is notable is that yields declined even while inflation remained elevated. In other words, the bond market is currently signaling confidence that inflation pressures will moderate over time and that the economy can continue growing without forcing the Federal Reserve into a more aggressive tightening cycle. For now, bonds appear to be supporting the equity rally rather than fighting it. This past Friday marked 3 months since the start of the U.S.-Iran conflict on February 28. In the early weeks of the conflict, markets reacted sharply as oil prices surged, shipping through the Straits of Hormuz was disrupted, and fears grew that the conflict could evolve into a broader regional war. By late March, the S&P 500 had fallen roughly 8% from its highs. The Dow would enter correction territory after shedding nearly 4,000 points, and the global markets faced significant pressure as energy prices climbed above $120 a barrel. Fast forward to today, and the story looks dramatically different. The S&P 500 has recovered all of those losses and is now up approximately 5% since the conflict began. The Nasdaq has even been stronger, gaining roughly 10% over the same time period, fueled by continued enthusiasm surrounding artificial intelligence, strong corporate earnings, and robust capital spending on the AI infrastructure. Even the Dow has recovered virtually all of its losses and is roughly now flat to modestly positive since the conflict began. If we measure from the market lows in late March, the recovery has even been more impressive. The S&P 500 rallied nearly 17%, Nasdaq more than 20%, and the Dow up about 13%. This is another reminder that markets often begin recovering long before the headlines improve. Investors who stayed focused on their long-term plans through the volatility have once again been rewarded for their patience. May turned out to be an exceptionally strong month for investors. For the month, the Dow gained 4.3%, S&P up 6.3%, and the Nasdaq was up 9% for the month. Small caps participated as well, Russell 2000 gaining 6.5%. International markets were strong. Emerging markets were up 9.5%. Technology led the way, rising nearly 15% during the month, while oil prices fell nearly 18% as geopolitical fears eased and investors increasingly priced in the possibility of a lasting ceasefire agreement. As we begin June, investor attention shifts from geopolitics and earnings back towards the economy, the labor market, and the Federal Reserve. The most important report of the week this week arrives on Friday morning with the May employment report. Investors are going to be watching job creation, wage growth, labor force participation, and the unemployment rates for clues about the health of the economy and future Federal Reserve policy decisions. The economic calendar begins today with ISM manufacturing and construction spending. Investors will be looking for signs that manufacturing activity continues to improve despite ongoing uncertainty surrounding global trade and energy markets. Tomorrow, attention turns to JOLTS, the job openings and vehicle sales data. Job openings remain an important indicator of labor demand and whether hiring activity continues to cool gradually or rather than abruptly. Wednesday brings a busy day with ADP employment report, ISM services, factory orders, and the Federal Reserve's Beige Book. The Beige Book will be closely watched for anecdotal evidence about how consumers and businesses are responding to higher energy prices and the lingering effects of the Middle East conflict. Thursday features weekly jobless claims, productivity data, and unit labor costs, all of which could influence expectations for economic growth and inflation. In addition to economic reports, we're going to hear from a number of Federal Reserve officials throughout the week. Tomorrow, we'll get Kashkari and Hammock. On Wednesday, we'll get Barr and Logan. And then Thursday, Barkin and Daly. And then Friday, Barr is going to speak again following the employment report. With markets sitting at record highs and the S&P 500 coming off 9 consecutive weekly gains, investors are going to be paying particularly close attention to any comments regarding inflation, interest rates, and the Fed's outlook for the remainder of the year. On the earnings fronts, investors can hear from Dollar General, Five Below, Palo Alto, CrowdStrike, Broadcom, and Lululemon. Broadcom's report may be one of the week's most important earnings events, given the market's continued focus on AI spending and semiconductor demand. Technology World will also be focused on Computex in Taiwan, one of the largest technology conferences in the world. NVIDIA CEO Jensen Huang will deliver the keynote address, while executives from Intel, ARM, and Qualcomm are also going to participate. Given the market's continued obsession with AI infrastructure, chips, servers, and the next generation of computing, any announcements from Computex could influence technology stocks throughout the week. As we begin June, the market's primary themes remain unchanged: artificial intelligence, inflation, interest rates, and geopolitics. Investors have been willing to look through the uncertainty and focus on strong earnings and resilient economic growth. Question now is whether those fundamentals can continue supporting stocks after a remarkable rally that has carried the major averages to all-time new highs. As always, stay focused on your plan, not the noise. Have a great week.